Hello, everyone, and welcome to today's Savvy Investor webinar brought to you by Diamond Hill Capital Management, titled Why Core? Opportunities in the Securitized Market. My name is Douglas Gimple, and I'm the Senior Fixed Income Portfolio Specialist at Diamond Hill. And joining me today on this webinar is Henry Song, Portfolio Manager at Diamond Hill for our fixed income strategies, which include short duration, intermediate, and core. Our investment philosophy is focused on bottom-up security selection with a focus on relative value. This long-standing approach to fixed income markets has led to a historical overweight to the securitized sectors, the topic of our conversation today. Henry, portfolio manager Mark Jackson, and I joined Diamond Hill together in 2016 with the goal of continuing a philosophy and process that began in the early 1980s and has remained essentially unchanged, even as the markets have continued to evolve and grow. So what we want to talk about today, why core? And then within core, finding opportunities within the securitized market. So what we're going to start off with is a high-level overview of the core fixed income market. And for reference, we're going to use the Bloomberg U.S. Aggregate Index as a reference point. But we also want to look at the overall market, because one of the things that we know and that hopefully that you realize is that the index is not all-inclusive. And this first chart here really breaks down what that means exactly. And we'll start on the left side with treasuries. That's the largest, most liquid market that's out there. But what's interesting is that, rules within the index prohibit the inclusion of some areas of even the treasury market. So you can see that $21.8 trillion market, 10.1 trillion is included in the index. So less than half of the treasuries are included, and it's for a variety of reasons, whether it's maturity limitations, structure, such as treasury inflation protected securities or TIPS are not included in the index. Treasury strips, which essentially take a principal cash flow or an interest cash flow and break it out into a separate security. Those are not included in the index, and that's where you can find some opportunity even within treasuries. You look at credit. There's some limitations there, but what we're really going to focus on today, as the title of the presentation indicates, is the securitized market. So within mortgage-backed securities and within asset-backed securities. And so the mortgage-backed securities market, about 10.5 trillion, about 70% of that is included in the index, really because the index only looks at agency pass-throughs. So not looking at collateralized mortgage obligations or CMOs or other types of securities in the mortgage industry, which we're going to get into a lot more detail about. And then asset-backed securities. One of the things here, we've excluded from this analysis CLOs and CDOs, which are technically considered asset-backed securities. But for this exercise, we've removed those because they are not part of the index. And frankly, we're biased. We don't include those. We don't look at those when we're investing in the markets. But here you see that around 10% of the ABS market is included, and it really gets back to those rules, and that's something we'll talk about further on, but something that we think is a great opportunity for investors. So when we look at a pass-through mortgage, I'll provide kind of this high-level overview, and then Henry's going to get into some of the nuts and bolts, where we can find opportunity, how we're doing different analysis to find those opportunities. So looking at a pass-through mortgage, this illustration shows you that, in that top cylinder or cone, you've got a variety of mortgages. And think about, in your neighborhood, how many mortgages there are. And each one is maybe paying a little different interest rate depending upon when they financed or refinanced. But what we do, or what investment banks have done, is they take and pool these mortgages together. And you see anywhere from 5.75% to 4.75%. Put it into a pool, structure it in such a way so that you've got an average coupon for an investor. And in this instance, we're looking at 4.75% is getting paid out to the investor that's buying a pro rata share of this pool of mortgages. There is a 50 basis point servicing fee that comes out between what the borrower is paying and what the investor will get. But as an investor, you are now getting every month principal and interest from all of the mortgages in the pool that are paying. And what makes the mortgage market different than credit, different than treasuries, is that these mortgages As if you're a homeowner, as you know, these can be refinanced, they can be prepaid, and that creates more risk. If we're looking at, and in this presentation and these examples we're talking about, we're looking at agency mortgages. The real question here is not risk. If you believe that the U.S. government is going to be around, then backed by the U.S. government means that there's not the credit risk that you would find in credit markets or non-agency mortgages, but it's really about timing. When am I going to get paid? And this becomes a risk when interest rates are in flux. So for example, as rates came down at the beginning of the pandemic, as the Fed pushed rates to zero and the 10-year Treasury dropped to historic low, what we see is that refinancing activity picks up. Because if I've got a mortgage and I'm paying, let's say 5%, and I can refinance to 3.5%, why wouldn't I, right? There's the upfront cost, but as long as the money I'm saving on a monthly basis going forward, eventually negates that upfront cost, then it's a good decision. And so what we see in the mortgage market is as rates come down, you're getting paid back much faster as homeowners refinance. And so you're getting hit with a lot of cash coming in when you really don't want it, because you have to reinvest at lower rates because rates have come down in the market. And conversely, as rates extend and I'm an owner in a pass-through mortgage, I'm getting less and less cash because people aren't refinancing. And so they're extending their mortgages out, and I'm getting less cash in an environment, rising rates, where I want to be reinvesting that cash and I don't have as much cash to reinvest. So that's where the prepayment and extension risk come in when we talk about pass-through mortgages. That's kind of a very high-level overview. I'm going to pass it over to Henry, let him get into some of the nuanced details when we look at the pass-through market.
Thank you, Douglas, and thank you for joining us today. On your screen right now is an example of a pass-through mortgage. Here we use a Fannie Mae 2.5% January issued pass-through, just as example. So one of the things I want to kind of point to is the prepayment and extension risk that Douglas talked about. If you look at this chart, there's all these PSA numbers at top, 277, 98, all the way to 1897. That is it's just a convention measuring prepayment speed, right? So what that means is, we don't know how fast these things will pay, but based on the future movement of interest rates, it could pay at these different speeds depending on the rate move. What that results in, what I really want to point to is in the bottom, where you see the average life and mod duration. So that is the key thing you want to focus on. If you look at on the 277 PSA, far leftmost column, it has an average life of 5.6. That is kind of the consensus speed that people are thinking how long this mortgage will be. But if you look further right, it gets to as long as 10.41 or as short as 1.18. So that is the variability in the prepayment extension risk that you're taking on by investing in pass-through mortgages. And that sort of extreme events doesn't always happen, but as we have seen in the past few years, it can, right? If you think about where we were in 2016, where rates was, then we went down this rising rate environment up until COVID hit. Then Fed cuts rate, the rate dropped quite significantly. 10-year hit all-time low. Massive refi happens. Frankly, before that, we haven't seen 2.5% coupon mortgages in a very long time, right? These people are basically getting a 30-year mortgage for, probably right under 3%, or right around there. And right now, frankly, if you look at this, you would think, okay, rising rate environment, this bond is likely to pay very slow, right? So far in January, you're seeing the rates going higher. So what is the incentive for these people to ever refi unless they're moving or they're, selling their house? Some sort of a natural event that occurs as opposed to a financing decision. So this bond is likely to be much longer now than investor kind of anticipated when they probably first bought this. So that's the extension risk that we're already seeing playing out. Very much the opposite of what happened post-COVID, the huge contraction prepayment that occurred in the marketplace. And part of that as well is this sort of, I'm picking this example because this is a dominant type of mortgages now in the Ag Index. If you think about the index, people who had higher coupon mortgages have been prepaying really fast the last couple of years. So those mortgages, and there's not so much outstanding anymore. We definitely have more lower coupon mortgages now presented in the index. And that's the biggest reason why the Ag Index duration has extended quite a bit in the last couple of years. We have seen this mass extension, and now investors take a lot more duration risk investing in core fixed income because of this. And this next slide is a screenshot of what we call to be announced mortgages, or we call them TBAs. So what this tells you, what this chart really shows here is if you look up top, there's a 2.0, 2.5, 3, 3.5. That is a coupon rate of the mortgages that's outstanding. The nature of the TBA mortgage, how it works is this almost works as a futures contract. So say I'm an investor, I want to go out there and I want to say, okay, I want to buy 2.5% coupon mortgages, but I just want to express the view that I think this is the best prepayment risk, what have you. So I can buy the 2.5%, and you will see there under there, it says 102-00 plus / 02 plus. That is bid-ask spread. And the 00 plus and 2 plus is by market convention off of 30 seconds. So 0 divided by 32, that's kind of, or 2 divided by 2 plus, that's 2.5 is a plus, 2.5 divided by 32. Don't ask me why, but mortgage investors gets really granular in terms of decimal points, and we don't use decimals here, unlike in the corporate market. And then if you look, so that what that means is on a certain day in January, defined date every month, that I need to decide, there are a few things I need to decide. A, I'm gonna take delivery of these mortgages, but I don't know what I'm gonna get. So if I bought it from bank A, or at broker A, I say, okay, I'm buying this 2.5% mortgage in January. On that day, give me bonds that fits a criteria here, which means a 30-year mortgage, 2.5% coupon, and that's it, right? I can't really pick what it is, and so they would just give me a lot of pools, a lot of pass-through mortgages that fits a bill. But what's the incentive for them to give me something that's really nice? They don't have any. So you tend to get the worst delivery bonds. The other option I can have is I simply don't want to take delivery of that. So what I can do before that is I can close out the mortgage, basically selling off the contract. So kind of like a futures contract in equity, you kind of just close it out. So you never really take delivery of anything. You just simply close that out. So you own it for a little bit, and you close it out whatever price it may be on that at that point. The third option is what we call rolling the mortgage. And so you might hear some managers talking about dollar roll. So if you look at that 2.5 mortgage chart, on the top line it says January is 102, but if you drop to February, it's 101-23 plus / 26. What that means is, okay, I don't want to take delivery this month. Let me delay one more month to February. The price drop there is an expression of how much the market anticipates a prepayment there is to be in that 1 month, hence the price drop there. So investors can analyze and think about whether that price drop that makes sense to justify the prepayment there may be. So there's always a break-even point. So it's analyzing on a very macro level where you think 2.5% coupon mortgage is going to prepay for a month. And you can do this indefinitely. So you never really have to take delivery of any physical bonds. You can kind of just continue to roll this. So it's a common tactic or strategy rather that a lot of large investors, investment managers utilize. They want to express a view. So for example, if index has 10%, 2% mortgage, 8%, 2.5% mortgage, you could express a view saying, I like the 2.5 better. I want to own 10% 2.5, 8% 2%. mortgage. So you can underweight, overweight different coupon stacks to express that view. So that's one way. It's more on macro way of investing in the mortgage market. Now I want to introduce you to a third way of looking at pass-through pools. This is what we call specified pools. As we talked about earlier, every pass-through pool is just a pool of mortgages that fits a certain criteria that gets packaged at a certain time, right? They're typically everything that's originated within a month or two. Now, if you think about the pools that's outstanding, these are 30-year mortgages, right? So it's in theory, you can actually still find mortgages that's been outstanding for 29 years. They only have 1 year left, right? But they might be only down to 1 or 2 loans at this point. But you can find them, they're out there. So on this screenshot here, we have a lot of these red box. Basically, it's a lot of information. Every pool that you buy, you can find out a lot of information about the underlying borrowers. You know, top right, are they owner occupied? Are the investment properties, right? Why do we look for that? Because investment properties are harder to refinance. It costs more to refinance. The hurdles are higher. So they tend to refinance slower, which offers more prepayment risk, prepayment protection. Now think about if you had a higher coupon mortgage, it's harder to refinance that. So it's likely that you can find a 4.5% mortgage outstanding that's paying much slower than your typical homeowner-owned mortgages. The chart, a smaller chart on the lower part, shows the original loan size. That is traditionally the most predictable way of gauging how fast a pool will prepay. You know, it makes sense, right? The lower your mortgage balance is, the less incentive you have to refinance. You know, so what happens is at origination, some of the banks would intentionally pull all the, you know, in this case, you see the max there is 110,000. So we call that 110 max pool. So intentionally pull all the lower balance mortgages together and make this specified pool. Why do they do that? They do that because they know investors will pay up for that. So these type of mortgages, if we go back to the chart about TBA mortgages, if we're making a 2.5% pool, say currently that's where it is, but if we have one that's 2.5% coupon, but it's 110 max loan size, that pool in the market is not trading at 102 for January. It's trading much higher than that because people will pay up. So the TBA is almost like the benchmark. Everything else, it gets quoted kind of off of that. So what we call that's a payout from that. And you can bet that if you were just take delivery of a TBA, no one will ever give you this 110K max loan size pool because that's too valuable. No one's going to give you that. You're going to get the most generic, you know, again, worst delivery pool possible. If you want something that's nicer, you kind of have to, you know, pay up for it and look for those. The other advantage of looking at the specified pools is you don't have to just buy everything that's new, right? Like I said, you can buy pools that's been outstanding for a very long time. You can buy something that's been outstanding for 10 years, right? So they have gone through multiple rate cycles. The homeowner had plenty of opportunity to refinance along the way, but they haven't, right? So there might be some burnout effects. So there are other things you can kind of pick. There are geographies you can pick. It's a lot of historical data showing certain states tend to pay slower for various reasons, the state legislature related reasons. There are other things you can kind of look for servicers. Some servicers are more aggressive than others to get their refinance. So there's just a lot of different attributes for the mortgage investor to kind of dig into it and look for a pool that makes the most sense for them. So that's kind of how we approach mortgages. We want to be like bond pickers. Certainly it takes a lot more work in this instance as opposed to making a macro view on prepayment risk. But we think the margin for error is much lower here because if you find the right characteristics, if you build a portfolio of these sort of mortgage pools together, you're going to be a lot better protected against any sort of prepayment extension risk.
Thanks for that, Henry. That was great. And one of the things that we want to talk about, as Henry mentioned, you know, looking at TBAs, is something that is more macro, making a bet on the direction of rates. And as talked about earlier, our philosophy and process is rooted in security selection, bottom-up, value-driven, really making more smaller decisions than any kind of macro overlay. We try to avoid those. So how can we get access to the mortgage market outside of specified pools if we're not looking at TBAs? Well, the answer is on this page and looking at collateralized mortgage obligations, or CMOs. So this is another version of the mortgage market, if you will, and I'll walk you through kind of the funnel and what we can get out of this market, and then Henry's going to get in a little bit more detail. But starting at the top, the same idea of what we saw before with pass-throughs, and that we're pooling together a bunch of mortgages. And what investment banks realized in the mid to early 80s was that they could take these pools and then cut out certain cash flows and structure deals that would meet the needs of different investors that maybe didn't want to get that prepayment and extension risk that you get with pass-through mortgages. So they pool them into a funnel, and then they take and break out the different pieces or tranches. And just some of the examples below, and I'll walk through these, and then, as I said, I'll turn it over to Henry and let him get into more detail. But left to right, interest only. So very, very obvious what that is. It takes all of the interest flow associated with that mortgage pool, and that's all that you would receive as an investor. Principal only, as it says, you're receiving just the principal. And so where's the benefit here? The benefit is that if you want much longer duration, you're going to get that with your principal only strip. If you want shorter or even negative duration, you'll look at interest only. But you can also look at, buying an IO or a PO, or I'm sorry, an IO and a PO, and, synthetically creating, that interest and principal flow that you would get from a pass-through. But if you can maybe buy that at 98 cents on the dollar as opposed to a pass-through at par, you're getting a little bit of that incremental value. You can also, get greater diversification by looking at an interest only that's more focused in California and a principal only that's more focused in Florida or New York, or insert any state that you would think of. And so that's one way of using those securities within the context of the overall portfolio. Then you have a tranche called planned amortization class. And this is a class that's structured in such a way that, it has, certain ranges of prepayment speeds, both faster and slower, in which it is protected. And how is it protected? Well, it has underlying support tranches. And these support tranches will essentially absorb excess cash flow if rates are coming down, refinancing is picking up, you've got more money flowing into the pool that, again, you would be stuck reinvesting at these lower rates. And so the support tranche will absorb some of that excess cash flow to keep the PAC bond, or planned amortization class, within a certain range. And then conversely, if rates are going higher and you're getting less money in because prepayments are slowing down, the support tranches will give up some of their cash flow to keep that PAC bond within its certain range. So what does this mean? This means that the PAC bond can be a bit more stable in periods of fluctuating interest rate environments, and the support tranches will be a bit more volatile, but you get paid to take on that potential volatility. So there can be opportunity with support tranches. There can be opportunity with PAC bonds. And that's where we get into that bottom-up security selection, as Henry was talking about. The hard work that goes into building a portfolio of mortgages is really understanding how all of these different structures interact with each other. And then you have a sequential bond. And that's essentially that if it's, we'll call it, there's an A, B, and a C, the C tranche is not going to get paid down until the A and the B pay off. So if you think about it as kind of stairs, you're going down the stairs, the first step gets paid, the second step gets paid, and the third step, you're basically getting paid to wait. And then you have things like a Z tranche, which would be the last bond to get paid. You're accruing interest the entire time, and then you get paid last. And then there are other machinations within the CMO market that, again, are tailored to meet certain requirements or expectations of investors that have come about from structuring all of this. So I'll let Henry get into a little bit more detail on CMOs and how we look at that market.
Yeah, so I mean, I think the key takeaway here is there is infinite iterations of CMOs that you can make. At the end of the day, you have a stream of cash flow from a lot of underlying pass-through pools, and then you're just slicing and dicing them. Really, there. I think if you think about the example of a pass-through pool we talk about, even if you own, say today you own like 2 or 2.5% coupon mortgage that you think you might be pretty long, like a 10-year bond. In the CMO format, you can make that much, much longer, right? So for example, in the sequential example Doug gave, you can make the last piece, Doug mentioned the ABC structure. You can cut it even more granular, or you can make a very, very small C class. For example, the C class only takes 1% of the cash flow of this large pool of assets. That means 99% of the pool needs to pay off before the C class gets a dollar of the principal back. You will always get interest, but not principal. So you can make a sequential mortgage that's 20 plus years long very easily in that sense. You just can't make a lot of size, but you can make them very long. Why does that matter? Well, because if you think about like someone like a life insurance company, they can now look for mortgages that are long enough to match the liability needs, as opposed to always looking at 30-year corporates. In fact, you can make this mortgage much longer in weighted average life and duration than a 30-year corporates can. So it fits a need, right? Conversely, if you think about some people who want short-term assets, like banks, for example, to match their deposits, which is very short-term in nature, they definitely don't want something like that. They want something very short and predictable. So you can make a very short front sequential bond that will pay off in a year or two, or even as short as a money market, right? So if you think about a pool of assets, you can say, okay, everything, all the principal coming through will pay off the first bond. And if you only make that a very small 1 or 2% at the front end, you're almost certain, even with no prepays, there will be enough natural principal payment coming through to pay the bond off in less than a year. So you can make a money market CMO out of that, and there will be demand for it. So for that reason, as you can see there, we go through this exercise of slicing and dicing, building different cash flows. The other thing about it is these CMOs are not structured by Fannie or Freddie or Ginnie Mae, right? They're assets that's back. They're Fannie and Freddie, Ginnie pass-through mortgages. But who's doing the slicing and dicing? Well, most of the time it's the investment banks. And they can always do them again and again. So you can make some CMOs, you can rewrap the CMOs again and cut up the cash flows again, right? You can use some CMOs, add some new pass-through pools that's just originated, then cut up some new cash flows again. It's all about finding, the dealers trying to optimize the cash flow so they can kind of sell the mortgage to match the needs of the investors. So it's as you can see, it gets quite complicated, and it gets interesting because at the end of the day, the valuation of these things is largely based on how each investor views prepayment. And it's not exact science, right? No one can say their prepayment predictions always spot on, because that's just impossible. So everyone's always willing to pay for these at a different price. In that pass-through example, if I think if a bond is going to be a 10-year bond, I'm going to pay a very different price for that bond, as opposed to someone who thinks that bond is a 2-year or a 5-year. So that's what makes the market interesting, but that's also what makes this particular part of the market quite inefficient in that sense, because for the exact same bond, you could be points off where you're willing to pay, as opposed to the corporate market. Everyone gets quoted, where a large bank's 10-year paper trades. There's really not a lot of differences there. The difference is depending in where you think the credit is migrating to, but in terms of trading level, the market basically is very efficient from that perspective. This mortgage market, as you can see, is very inefficient, and that's where we felt we have advantage from our history of picking mortgages and how we have performed in the past, we feel like this is where we can offer a little bit of an edge in the marketplace and can build a better portfolio by utilizing specified pools and CMOs.
And I think an important point before we move on to our next topic, which is the asset-backed securities market, I think an important point is that, when you look at, what's gone on in the mortgage market and how it's impacted the index, that as rates have come down, even though they're tilting towards the higher side and starting to increase as we expect the Fed to launch a tightening cycle very soon, what we see is that, as mortgages extend because rates are going higher and you have less opportunity to refinance, the index extends quite a bit. I mean, we're approaching, almost 7 years now, which is considerable extension because so many people refinanced or got their initial mortgages at such low rates over the last several years that, the idea of refinancing is going to fade away, or at least is going to reduce substantially. You'll still have, as Henry mentioned, life events, divorce, death, relocation, where you'll have to pay off your mortgage. But for the most part, if you've got a 2.5% mortgage, what are the odds you're going to refinance in the coming years? It's probably pretty low if we make the assumption that rates are going to continue to go higher. So the risk then becomes, owning those TBAs, owning those pass-through mortgages, you're going to experience that duration drift higher. And CMOs are a way that we have found to kind of mitigate some of that risk. Now, the math dictates that if you own a mortgage, whether it's a CMO or a pass-through, your duration is going to extend, but you can minimize or limit some of that duration extension through the use of CMOs. And so that's something that we have continually focused upon, that as people talk about rising rates and worried about core and worried about duration, that's something that we have used actively for years to help mitigate some of that risk. And so with that, let's move on and talk about asset-backed securities, another part of the securitized market that we focus on. And this chart just is kind of a level set of, the growth that we have seen in the ABS market. Again, not looking at or including in here CDOs and CLOs, but that's not an area that we're necessarily looking at. But what the history shows is that the market was ramping up, exponentially by the time you got into the early 2000s. By the time you got to 2007, the peak, and then you had the financial crisis, and things dropped off, as you can see, and then they've started to come back. And in year to date, or at least now that we're through the year, 2021, we've seen record level of issuance in the ABS market. And that's something that, not only was there a record issuance, there was appetite for it. And so as the market has continued to evolve and change and grow, investors have accepted that change and really started to put money into those markets. But, it's still broadly diverse. It's an area that we really like. It's shorter duration securities. So unlike on the mortgage side, where you can get some longer duration, typically you're looking at maybe 3 to 5 years of duration, depending upon where you are in the capital structure. And that's something that we'll talk about in just a bit. But it's an area that we really like. So we're going to get into a little bit more detail. I'm going to go through the next page, and I'll let Henry, add some color. And then we've got one more page, and then we'll go to your questions. But, really, starting at the basics for, these asset-backed securities, we want to look at subordination. And I think this page is important, and what it illustrates is important because it shows that, as an investor in the asset-backed market, you can kind of pick and choose your risk tolerance and where you want to be in the cap structure. And what I mean is, if we look at, the credit tranche, the AAA rated, the senior class, the AA, single A, triple B, and so on, as an investor, we can pick where we want to be. If it's a prime auto issuer that we've known for a while, has been in the market for a very long time, and there's history around, the way they structure their deals, maybe we're willing to look at, the triple B or even the double B tranche to get some incremental yield because we view the risk as less because it's a known quantity. We know how they structure deals. We know how they've performed in the past. Compared to a consumer lending, securitized deal or even a subprime auto deal where maybe it's a new entrant into the market. We're not as familiar with them, though we do meet with them and understand how they look at the markets. There's not that history. So maybe we stick to the higher end of the structure, the senior class or maybe the mezz class that's AA or single A rated. And so, that's how we can kind of pick and choose as an investor based on our risk appetite, based on the collateral, based on the structure. And we'll talk about in the next couple of pages what the structure means. But here for subordination, if you're buying that senior class, all the cash flow is coming from the top down. Well, what does that mean? That means that as a senior class, you're getting principal and interest every month until your portion of the deal is paid off. And then at that point, we'll call it the AA tranche, then becomes the most senior that receives principal and interest. All of these tranches receive interest every month, but the principal payment is for the one that's at the top of the structure. And that as time goes on, that changes as deals pay off. And then also importantly, the losses flow from the bottom up. So losses are going to hit the equity, the subclasses first before it even gets to the senior class. I'll let Henry talk about that in a bit more detail as we look at this page.
Yeah, I think, in this sequential structure here, mathematically, as you can see, that the AAA class would be the shortest class because it's getting so much principal payment each month. And then the single B class will be the longest in terms of weighted average life and duration. But as Doug mentioned, as every month when the cash flow comes down and paying off, essentially you're deleveraging the entire structure because now, assuming first month there's no losses coming through, but more of the AAAs gets paid off. There are more bonds that's subordinating less senior bonds. So imagine a scenario where the AAA bonds get completely paid off. Now the AA bond is a front pay bond, right? So that bond gets all the principal. But so as you can see in the structure, the percentage of the collateral that's supporting AA just increases every single month, and that goes down the entire structure. So this deleveraging structure is the reason why commonly you see asset-backed securities as time goes on, as they get shorter, they get upgraded by the rating agencies due to this, because if the AAA were to be 3.5% support, they got that AAA rating at the beginning, the AA can actually get there fairly quickly as well. So once it hits that threshold, then the rating agencies, once they review them periodically, they can go in and say, okay, actually this is same credit as the bond that was rated AAA 6 months ago or 9 months ago, however long it may be, and upgrade these securities. So that's a key thing here in a lot of these structures.
So the other areas of credit enhancement are important because of the fact that, before we were talking about mortgages and we were focused on agency mortgages, and there really wasn't the credit risk. It was all about timing. Well, in the asset-backed market, you do have credit risk. You've got underlying loans to consumers that you will see losses. No one is perfect in their underwriting, and that you have to, account or anticipate a certain level of losses. So how can, the issuers insulate or protect investors from some of those losses? And so we saw subordination and the ability to kind of pick where in the cap structure you want to be based on what tranche you're going to be buying. But then there's these other areas of credit enhancement that we want to touch on. So excess spread. And I've put together an example here that shows you that, the weighted average coupon that the borrower is paying in this example is 15.21%. So that's every month, that's what they're paying. Then you take out servicing fees and you take out financing costs, which is really the weighted average that is being paid out to investors for buying this. So buying a tranche on average is 3.63% type yield. So what you're getting every month is over 9%, just over 9% excess spread. So payments coming in excess of what you are having to pay out from servicing fees and finance costs. So if we assume that, a deal is going to have 5% annual losses, you've got excess spread of 9%. So you more than enough to mitigate the losses that will be coming in, because again, there are going to be losses. people lose their job, anything can happen. And so there will be losses. So this is a way to kind of mitigate some of that impact. Another way is, over collateralization. So in this example, we've got a deal balance, loans of about, we'll call it 450 million or 450 million, I'm sorry. Issue balance of 440 million. So we're keeping, roughly, 9 million on the books, on the issuer's books, that will take those first hits as well. And so that's over collateralization. And then you've got a reserve account, and that's simply, taking 1 to 2% of the deal that's set aside in an escrow account. That's just cash that's set aside. That again is there to mitigate some of these losses. And so, the difference again, with mortgages on the agency side that we were talking about in the asset-backed securities, that there is credit risk. But with that credit risk is, the levels of protection, the credit enhancement, and then you also have the collateral. And if you think about an auto deal and really a subprime auto deal and the recovery that you can get, when you reclaim a car, if someone stopped paying and sell it at auction, that money comes into the deal as well. So I'll let Henry touch on this, and then I think we've covered what we want to cover, and we'll open it up to questions once he's done.
Yeah, so I think the key takeaway here is really that when you think about an asset-backed securities deal, or any sort of structured product deal that has a credit component to it, the rating is very different than a corporate bond rating. When you think about corporate bond rating, the question the rating agency is asking is, how likely is it for this corporation to default on their payment obligations, right? That's why you have investment grade and high yield. But here, it's not a question about how likely they're to default. It's how much you would like to see default happen. Because in a lot of these deals, you just assume there will be default, right? Credit cards, auto loans, student loans, there will be default. There's no question around that. The question is how much. And the other side of it is, how much coverage do you have? How much protection do you have against that? So we call that loss multiple, right? So if you think about a subprime auto deal, well, there will be losses for sure. But so how can you get a AAA rating off of a subprime auto loan deal? Well, so if you look at an issuer that historically has produced about 10% annualized loss in that space, in subprime auto, if you can structure 30-40% credit enhancement, that's 3 to 4 times the credit enhancement, then 3 to 4 times the normal losses that you're experiencing. That's a lot of extra protection, right? So then the rating agency can feel pretty good about it, because they can go back and say, okay, during 2008, during COVID 2020, they're seeing a spike, but they didn't see the spike anywhere close to touching the bonds and making the bonds vulnerable to actually taking any sort of principal loss. So that's a difference in concept in how you think about asset-backed securities versus corporate. So the natural question is, when the losses go higher, who is taking the loss if the bondholders are not? As Doug showed earlier in the chart, at the very bottom, we have that equity first loss piece. That piece is most often retained by the issuer. And that piece gets paid a lot. If everything's performing really well, then all the cash at the end goes back to the equity holder. If you see spiking losses, that piece is just worth less and less because they're absorbing all the losses. So during COVID early on, when you start seeing the spiking losses, well, the equity holder is taking the hit. As we've seen in 2020 during COVID, they really didn't see any bonds taking principal losses because the bonds are structured in a way that can withstand a lot of stress. Even on the double B class are often structured to withstand 1.5 to up to 2 times of normalized annual losses. So that's a pretty powerful, the structure is very powerful in these deals to protect against this. So as investors, we both look at the collateral, looking at the issuer, looking at the collateral, looking at the structure of the deal, as well as the levels that they're trading at to see if they're being, we're being compensated for it. So those are all things that we take into consideration when we're looking to the space that in structured product that involves credit risk.
So I think, when we look back on everything that we've been talking about, it's really about, differentiating and finding, as we say in the title, opportunities in the securitized market. I think we've demonstrated that, when you look at the ABS market, there are a lot of opportunities, especially when you consider how limiting the index is. So if you look at something that is trying to replicate the index, you're missing out on 90% of that securitized of the ABS market, because the rules are such that the index will only include autos, credit cards, stranded cost utilities, and only recently expanded to equipment, motorcycles, and device payment plans. And even then, it's still very limited. And all of these types of securitizations that have been created post-financial crisis have provided a lot of opportunity on shorter duration, higher yielding securities. So that's something that, again, helps to differentiate. And then you go back to the discussion on mortgages and differentiating through CMOs as opposed to pass-throughs or TBAs. So now I'm going to turn the tables and ask you guys what questions you have. And I've got some right here that I will put to Henry. First, when you think about capacity, how do you think about the securitized market and how it impacts the capacity of either of your short duration or your core strategy?
That's a great question. I'll first say this is more of an art than a science, because the markets are ever changing. We kind of look at our historical allocations and where we would like to be. So we kind of sizing up that part of the market, right? So the market's big, but some of the part, as we talked about before, we don't buy CLOs. So that's one market we won't touch. So we kind of look at it and say, okay, what markets do we typically like? What kind of allocation do we typically like to build for a portfolio? And then we look at this, the participants in the marketplace and say, okay, in these type of deals, typically when we go in and you buy a new issue, what kind of size allocation can we actually expect, right? Some of these deals may be fairly small, so it doesn't matter how big you are, you can only put so much money to work at times. So those are all like factors we kind of factor into it. And then we provide a range because, again, the market, as you mentioned before, the asset-backed securities market has been growing pretty rapidly post-financial crisis. So we kind of want to not put exact number because this is not exact science. And then we review them annually to kind of check to make sure our range still makes sense. That's kind of how we come up with capacity for all of our strategy.
So I've got a question here on derivatives. Do you utilize derivatives of any kind to hedge interest rate or credit risk?
We do not. So a couple of things. One, our portfolio all cash bonds, so it's very transparent what we do. In terms of credit risk, really we don't believe in hedging that because if I'm looking at a bond with credit risk, I'm buying that so I get compensated for it. So we're doing the credit work to make sure that we feel comfortable with the credit. There's no reason to kind of hedge away a lot of the returns in that sense. In terms of interest rate risk, we don't hedge that either. Short duration strategies, you can argue there's not a whole lot of duration interest rate sensitivity. For intermediate and core strategies, there are more of it. But it's our experience that most investors hire us. If you hire us as core managers, you have kind of accepted the duration risk of a core mandate. I think really that's more of a question I think for asset allocators to think about how core or intermediate fixed income will fit in their asset allocation, as opposed to for us to kind of dictate, okay, like we want to be short here, long there. That's not what we do. Our goal is to be the index, and we want to excel at that and protect against the index from a downside perspective.
So a question on a hot button topic. Any thoughts on the potential of ESG investing in the securitized market?
Yeah, I mean, that's something we've been looking into pretty closely. I think the market's in pretty active discussion there. There's just still a lot of questions, the answers at this stage we're exploring. I think, if you think about ESG, mainly people have that focus on equity, which directly translates into, investment grade and high yield corporate bonds, but a lot less in the securitized product space. If you look at the securitized product space, the biggest portion is in mortgage-backed securities. Most of them are agency wrap. It's really hard to really assigning some sort of ESG score for someone's home, right? You can make a case for certain green improvements for the homes, and there are deals like that. There are commercial mortgage-backed securities securitized by highly efficient new office buildings, things of that nature. But that's still very much a small part of the market. The bulk part of the market is, it's tougher to say. There are affordable housing, there are workforce housing, there are housing for certain rural areas, things like that. You can kind of make it, say like that's great from the social aspect of it. But again, that's just a very small fraction of the market. I think the market stands right now, it's near impossible to build a portfolio of solely ESG focused securitized bonds at this point. But certainly that's something everyone's paying attention to. From like all the natural disaster risk, flood risk in certain regions, fire risk in other parts of the areas. Those are all things that we are definitely taking into consideration when we look at these investments to make sure we understand the risk, right? Even an agency mortgage, you could see a prepayment risk as a result of some natural disaster, things of that nature. So that's certainly something we're keeping our eyes very closely to, and we try to incorporate as much of that as we can in our analysis and decision-making process as well.
So I'm looking, and I've got one last question, Henry, and I know you love this question. What do you say to investors that are concerned about the impact of rising rates on their core bond allocation?
Oh, we're already seeing the short-term rates hike a decent amount, so the market's doing the job that Fed hasn't done yet. So from that perspective, if you're still in core, or if you're not yet in core, this is a much better entry point now than a few months ago. It's just still highly uncertain where long-term rates will go. There's certainly a lot of short-term inflation noise right now, and that might persist for another year or so. But if you think about where we were just a few years ago before COVID, everyone is very confident we have seen the lows of interest rates in the last few decades. That only for us to revisit that shortly after was COVID. There's just so much that can happen in the world that it's hard to say like we will never see these low rates again. So I think it's again, I think it's important for asset allocators to look at their entire portfolio and see what role is core bond playing in their asset allocation. Is it really to buffer against some sort of disruption in the equity market? I think it's important to, in that case, to really look for a manager that demonstrates that their core has a negative correlation or very low correlation to their other part of the portfolio in that sense, right? So I think that's as opposed to someone who's really, take on a lot of risks similar to the rest of the portfolio that you already own. So I think those are would be my suggestion for looking at thinking about how core or other fixed income instruments kind of fit in the overall asset allocation.
Well, Henry, I want to thank you for your time today, and thank you to everyone that joined the webinar, and thank you, Savvy Investor, for putting together this webinar.